Martin from Needham.
Thanks, Chris. So, Jeff, one for you. Love the shopper marketing initiatives. You're spending a lot of money on that and a lot of money on data. To me, they feel like they're at odds. Shopper marketing closes the loop between an ad buy and a clear return on purchases. So doesn't data become less valuable over time the more you can close that loop, because data is a proxy for the return on ad spend? So it feels to me like you're spending money on two things that work against each other. Could you speak to that, please?
Sure. Honestly, I've never thought of it that way. In large part because we're using the data, and incidentally, Samantha, I'll pass it to you after I I take a stab at this. But we're using the data to make more informed decisions so that people can get a higher return, right? So you want to advertise to the people that are the most likely to convert. That data helps you make a more informed decision about where you're advertising. Without that, and I think over time, incidentally, I think more and more companies are going to give you the measurement for free and then charge you for the targeting capabilities. So if you look at it that way, where the data is being invested sort of in the middle to incentivize people to be more effective and optimize their entire marketing spend to sell product in those few retailers. That from the retailer's perspective, they want that, of course, because they would love to have a CPG spending billions to sell more product in their stores, which creates obviously a flywheel for them. And incidentally, that's one metaphor that we use when we're talking to the retailers, which is you ought to think more about the flywheel in the way that Amazon does, because, of course, they have that benefit. But there's, of course, the same opportunity to do simply because it's offline doesn't mean you can't do it. And with the online to offline capabilities, it obviously can capture that. But then on the back end, you're just proving the efficacy of the data that you paid a small amount for in order to increase efficacy by far more than the cost of the data. It just creates a more efficient supply chain across the board. I don't know if you want to.
Yeah, the only other piece I would add is I think that different retailers have different levels of coverage or access. And so, for example, McDonald's, some people may have their app and provide their information or pay using a credit card, but a huge portion of their revenue is cash driven. And so when McDonald's thinks about leveraging data, there's portions of shopper data that may be of use, but I think there's also a lot of other data driven components that they'd want to leverage, from demographics to lifestyle to behavioral, that I think will be really important to continue to offer in the platform.
Thanks. Our next question will be from Tim Nolan from Macquarie.
Thanks. Question for Jeff or Blake or both, I guess. We've got an interesting scenario in front of us where we know the ad market looks like it should be slowing into the back half of this year, at least into next year, and yet you've got all these great structural growth drivers. I wonder if you could help us sort of suss out what we might look forward to in 2023. I mean, in past recessions, you've had ad dollars shift from traditional to digital. Now that big shift is linear TV to CTV. So that could be a very powerful structural driver. I know you haven't called out a Netflix direct partnership yet, but could be. Disney Plus you do have. Retail media is great. So is there a way to think about 2023 cyclical versus structural? Thanks.
So I'll take a stab at this. We'll both have our own crystal balls that we'll try to look into deeply, and you can tell me that mine's wrong. I think that the way I think about it is this shift from linear to CTV, I think is going to be faster than anybody believes it will be. Will it all manifest that quickly in 2023? I don't know, if it comes that quickly. But I think what we have shown from our history, and I've talked about this quite a few times, is that volatility creates discussion opportunities for Tim and his team that I don't know exist as well at other companies. This is just my anecdotal, personal opinion. But I do think that the linear shift is going to happen faster than people expected to, just like the streaming fixed shift happened. Now, COVID helped that, but it's also sticking, these kind of viewing hours. And I think it's just a question of, macro uncertainty. We'll just have to adapt accordingly, however that turns out with itself. We've adapted, like I talked about, with international and issues in Europe. But like I said, we have had the ability to forward invest in those places and be ready for it. And I'm very comfortable doing that because, you look at the global advertising market, I think 2/3 of it is outside of North America. And so just knowing that fact alone would say, if you believe you have an unbiased product where we can come in, represent the buy side and make that progress, we're in the best situation possible. But macro conditions is always going to be subject to that.
The only thing I'll add is just that, part of what you're asking is how strong is the headwind of economic sort of macro stuff that all of you know better than I do. And then how strong is the secular tailwind behind CTV and growth and move to digital? And the thing that's kind of interesting about the interplay between those two things is that, particularly in connected television, if there's stronger pressure on the consumer, both in the United States as well as outside the United States, I think you could argue we're already in a recession in Europe, that it puts pressure to move to AVOD. Consumers are interested in paying for it with ads. And that makes it so that everybody has to move faster into AVOD, especially when you really consider the content machines that all of them are and how quickly they need cash to continue to accelerate and grab land. So even if there is sort of stronger headwinds than people thought weeks ago, and who knows, like it's so hard to predict at this point. And I would argue, by the way, that, and I've made this argument in multiple forums before, that I believe there should be a VIX for advertising. It will never move quite as fast as the VIX does for the equities markets. But if we did have one, I think it would be at an all-time high right now. And that's largely because they're all looking at the same tea leaves you are, trying to figure out what the future holds. And there's just more uncertainty for them. So the average CMO is in a scan the landscape, head on a swivel mode right now. And I believe no matter what happens, the secular tailwind of television in the first half of next year will be something we've probably never seen before and will never see again. And that is going to be accelerated in the event that there are headwinds, especially unpredicted ones.
Just raise your hand if you have a question. We'll come find you.
Thanks. Hi, I'm Mike Morris from Guggenheim. Wanted to ask you about that sort of 16% CTV share and the 9% that's still sold direct, and what you see as the catalyst to moving that forward. Tim, I think you referenced inefficiencies in the marketplace that need to be worked out. From the media company perspective or the publisher perspective, it does feel like they want to really hold on to it tightly. So I'm curious, as you look over the next, 1-2 years, what do you see as the kind of tactical catalyst to help them see the light, if you will?
Yeah, there's a couple of things. So one is structural. So, and I think most of them have taken care of this already in that they've organized their, if I look at it through the lens of a content owner, they've organized their sales team now where pretty much everybody now has a sales team that is organized in a way that regardless of the door that the money comes through, they're all compensated the same way. This was not the case a long time ago where it was kind of like the linear team ruled all. Now I think they've organized their team where it's a little bit more fair. And then the other is technology. And so the slide that I showed earlier, one of the things that's happening right now in the marketplace that I think is going to solve for this problem is that when you look at all of that opportunity in the biddable marketplace, because of the way that some of the legacy technology is structured, it's kind of unable to capture that. And that's the efficiency in the marketplace that I referenced earlier. A lot of these guys are building for that end state. Like if you look at how Disney's starting to think about their technology stack, it's all designed to capture that opportunity because we've showed that same data to all of our broadcast partners. And when they see that opportunity and that missed opportunity, they're moving as fast as they can to figure out how they break that logjam. And I think once that's solved, both technologically and structurally from a sales team perspective, I think all of that direct kind of insertion order type money starts to move really, really quickly over into biddable.
The only way to get the CPMs that they need to fund their content is through an auction. And especially when you have something that's really unique and scarce, an auction is the very best way to monetize it. That's what they do in art and everything else that is unique and special. But if you look at, for instance, Netflix talking about $50, $60, $70 CPMs, that is only available in a biddable environment, in part because on the advertiser side, that's the only way that you can bring your data to the equation and control for reach and frequency. You put all that together and it's inevitable.
And the next question will be from James Heaney at Jefferies.
Thank you, guys. Jeff, you talked a lot recently about just gaining share from social media budgets. Are you starting to see that shift happening in real time, or is this more of a hypothesis and something that you see playing out over time? Thanks.
Yeah, I'll take a first stab at it, and then Tim, if you want to add any color. So I don't know necessarily what you mean by real time or how real time in the sense that is it happening right now or does it happen immediately when something changes? What I would in general say is that as efficacy as a result of Google and Apple changes to social, and that's not just Facebook, that's the entire category. As efficacy has changed, they all reassess. And as they've reassessed, they put more dollars into things like CTV and programmatic, where they have the opportunity to choose. It's also given them the ability to look more holistically instead of just in specific destinations. And the paradigm, that does take a little bit of time to understand why it's better to buy through an aggregator than to buy directly, because that's a bit counterintuitive to lots of other supply chains. But because we earn our keep in decisioning, that creates a much more effective media plan for the advertiser that then gets continued and perpetuated.
Yeah, the only thing I would add is like that paradigm that I put up earlier today, where a lot of the ways that social is being bought is kind of this like, well, I'll hand over my money and then let me know how it goes. And so that paradigm that I put up earlier, where you kind of got the old way of doing things, the publisher decides, because the social media companies are publishers at their core, that's what they do. And so that paradigm on the left side of the slide that I showed earlier, that's how they sell media. What advertisers want is what was on the other side of that slide, which is they want to choose and they want to bring their own data to bear. And that's been really difficult in social, especially for all the reasons Jeff talked about.
Hi, Sean Patil, Susquehanna. Jeff, you talked about in your presentation about how the wave is even bigger now than it was 3 years ago, 5 years ago, how you're seeing momentum across the business. You layered in shopper marketing. And my question is, it's more about end state, as you like to say. You have $1 trillion plus TAM. At end state, what do you think your penetration should be? What would you like it to be of that $1 trillion opportunity?
All of it. That's what I'd like it to be. But of course, we're seeking to create a competitive marketplace. We don't think that we can own all of it. We don't think any one company should own all of it. What was that? Oh. So instead, what we're trying to do is compete and get the lion's share. And the way to do that is to leverage the data of the advertisers that come to the table trying to make the very best decisions, to make the very best decisions for them so that they're objectively looking for efficacy wherever they can find it. That we don't have a dog in the hunt where we're comparing Hulu to Netflix to HBO to whatever else, to front page of Yahoo, to Snapchat, to whatever, that we're objectively buying whatever we can. So that then, and only then, can you go back to the advertiser with sort of a straight face and know that you've done the very best for them. And we think by taking that approach full of integrity and objectivity, that we have the very best chance to win more than anyone else. And so it's really hard to quantify, especially when you're looking at something like CTV. We're talking about a tiny sliver, or you look at what we're currently controlling of the $1 trillion TAM, and it barely shows up on a pie chart. So when you look at how early we are in the game, it's really hard to say where we'll land. But I believe this company has the best chance at having the largest slice of the pie as any other company.
The next question will be Mark Kelly at Stifel. Here you go, Mark.
Thank you, and thanks for all the presentations today. Greatly appreciated. I wanted to ask you about China a little bit more, Jeff. I thought your comments were pretty interesting, just that there's maybe some hesitancy from U.S. advertisers, going into the region. I guess, how do we think about growth for China relative to the domestic market over time, and does that dynamic change?
Yeah, I think the dynamic does change because I think over time people just become more economically rational, and you just look for ways to sort of capture an opportunity. So I think while advertisers look at China and say it's a different market, the way that I protect my data and also get return on spend is harder. The walled gardens in China are much bigger and control a much greater percentage of the market. And then outside of those, what's left of that, even though it's a smaller piece, it's much more fragmented. So they're bigger and smaller across the market. And of course, it's half the size of the United States, which sometimes deters people from spending time there, but it's growing twice as fast. So that also gives you an incentive to potentially try to spend time there. But it certainly gives you an incentive to focus on it on the long term, because I don't think it's likely to slow down or not continue to climb the charts, if you will. So what I think happens over time is that advertisers find ways to get in there. I think our partnership will bring more dollars and will create some equilibrium, if you will, where the market becomes more reflective of the rest of the world. But that is dependent on us executing and continuing to grow in China, which is just wide open for us at this point. I don't know if there's anything you want to add, Tim.
Matt Swanson at RBC.
All right, yeah, thanks. Jeff, you've mentioned a few times about how CPMs are going to need to fuel the content creation for AVOD. And I think it's a really interesting dynamic right now in SVOD. You could argue that all the content they're creating is just to try to stand still, right? That Netflix is just trying to hold on to the subscribers they already have. So as we flip to AVOD, and there's like a real tangible ROI to everything you create, right? Stranger Things, 50 million hours, that now has $1 attached to it. How does that change the content wars between all these AVOD vendors? And do you think that accelerates the amount of money that's getting poured into these platforms? And maybe even like how quickly we see more AVOD platforms pop up?
Yeah, it's hard to speculate on how many more AVOD platforms will pop up, but I do think it accelerates everything. And I've mentioned that I've always been obsessing about the supply chains. There was something that Reed Hastings said at a conference that we were at together a few years ago, where he essentially said, and this again was, 4 or 5 years ago, 80% of our audiences and 80% of our consumers or subscribers are in the United States, and YouTube's is inverted. And he was pointing it out, saying, I'm looking at outside the United States and saying that's where there's opportunities for growth. When you consider that the median household income in the United States is the highest in the world, and that right now consumers are under some amount of pressure as it relates to financing all the amazing content. What Tim said is really important, which is when you look across all these other countries, I mean, we were sitting in a country in Europe, and the player was talking about how the other member of the duopoly is the one they think about all the time, and we said, I would stop worrying about them and start worrying about Netflix and HBO and Disney, because those are global players, and all the regional licensing agreements that have created walls that prevented them from being here in other cases are going to be gone, and especially as they're creating their own content. So I think it actually makes it possible for them to grow more around the world, and I do think that makes it so that they can fund more content. And I'm not sure that it doesn't have dollars attached to it already. It's just you have to do it through subscription, and you have a different model, but you can still assign dollars to it. I just think there will be more dollars because consumers will have more choice, and I think that's better for the whole ecosystem. What I missed, Tim.
Yeah, I mean, I do think I think one of your original questions was, is it going to help continue to fund content? I think it's the only way they're going to help continue to fund content is through AVOD, right? Because if SVOD starts to slow or we kind of cap out on SVOD, then AVOD is going to be the mechanism by which they fund all of the amazing content that we all enjoy. And as that continues to expand, I do think that it's going to help fund the next Stranger Things, and it's going to come through ads. Because as I said earlier, there's two options: subscriptions or ads. And as long as they're keeping their eye on the ball as far as how they maximize the monetization of those ads through auction-based and biddable, just like we've talked about, I think it's going to continue to help them fund amazing content for years. So.
Great. Next question is going to be Mark Zagutowicz. Hope I got that right. At Benchmark Company.
Thanks, Chris. Jeff, you mentioned that the biggest risk to UID to have been addressed, and I'm just curious, as it relates to the EU, what's being addressed there, sort of what are the stumbling blocks? Last I had checked, it was that essentially they were looking for an administrator to UID to essentially address any GDPR concerns. And I'm just curious if you could give an update there. Thanks.
Sure. Samantha, do you want to go first, and then I'll follow up?
So it's kind of inherent in your question, but we've created a separate technology stack for Europe specifically. So I want to separate out kind of EUID versus UID2. And so for Europe specifically with EUID, we've seen incredible demand as publishers and advertisers and data partners look at this space as compliant and in the spirit of the laws in existence and the different court proceedings that are kind of underway. And so I would just say there's incredible incredible interest as we're working with some of the largest players in market and more of a closed beta. So testing it, getting data behind that to demonstrate the viability of the solution in that particular market.
Yeah, I'll just say that for those that don't know, what EUID is essentially a separate instance of UID2. So you can think of it like Chrome and Chromium, where one is a specific instance of the other. We basically created this opportunity to branch and take them in different directions, in large part to respond to different laws and legislation in Europe. There's a number of things as it relates to the technology itself that we may want to be just slightly different, but the general premise is exactly the same. So as Samantha said, we're in early stages of a closed beta. And honestly, we're just treading a bit more lightly there, trying to be very careful. But I'll just maintain what I've said before for now years on this topic. EUID, I believe, is the very best way for the entire market to accomplish all the things that GDPR is out to create, which includes the right to be forgotten, to give consumers consent and the power to take that consent with them so that it's not stuck in one place, in a walled garden without any transparency. And in order for them to take it with them and to have that right to be forgotten, as well as to make choices specifically with one sort of content owner at a time, I believe that it has to be through a technology very similar to UID or EUID. So I'm extremely optimistic, But there's obviously good reason to be cautious as well. The last thing I'll just say is that the administrator has never been the issue, whether that's in the United States or outside of the United States. Our issues have always been just trying to make certain that we do it right and get that to scale so that we can then let administration happen by independent bodies at scale. But we've never been in market to hand over the sort of power that has already been aggregated to someone else. That time will come where you want it to be run by a large group representing the entire market. But doing that when you're getting the plane in the air is not the right time to do that. It's once you get to that cruising altitude, which I don't think is that far away. But when we get to that point, then it will be administered by somebody else.
We have time for a couple more. Yusuf Squali from Truist.
Great, thank you, and thank you guys for presentations. I guess just following up on the UID2 and just maybe stepping back and looking at all the things that could potentially go wrong, right? I mean, I think you guys gave a great, kind of scenario analysis of all the growth opportunities, but within UID2 in particular, is there anything that Google can do to make your life difficult? There was talk potentially about making email-based target tracking and phone-based tracking maybe more difficult. At the browser level, I don't know if that's even possible or not. Maybe you can address that. And just generally, what keeps you up at night?
Perfect. I'll start on the first problems and you can go to the second set of problems. So, I would say the thing that's so incredible about UID2 is that it is linked to a consumer providing their information to the brand or to the publisher. And so it's not relying on a third party like a Google to somehow permission or track this user. It is the consumer is providing that information. They've got choice. They've got transparency. And so because of that, it will kind of survive in perpetuity and work across all ecosystems. And so it doesn't have a dependency where there's some sort of backdoor, if you will, because it is so transparent, it's distributed, it can be created in any ecosystem where the entity has, signed up to the appropriate contractual terms. And so because of that, it allows participants to connect with each other, it allows different ecosystems to connect with each other, and it allows providers to connect across ecosystems. So I feel really optimistic about it.
Yeah, I'll add, it's really hard to conceive of a way that you could prevent people from logging in to a destination that they love. I want to have a relationship directly with this company. You have to do a lot to intervene in that case. Imagine if you got rid of logins. Like, how does the internet work anymore? So as long as a destination can have that login, which, think of all the most important sites, whether you're talking about banking or DoorDash or Netflix, like all the things that you care most about, you're logging into them. And so given that this is built on top of that, and as well as that relationship between the consumer and those that matter most, I think it's extremely difficult to foresee a way that you could stop that, especially given that near the core of the value proposition of every company that would have any power to disrupt that at all are billions of logins that protect their own companies. So to answer your second question, what keeps me up at night? Number one, 2 teenage boys and a middle school daughter. That definitely is the thing that keeps me up the most at night. But as it relates to work, I would say it's honestly just executing. Like when I look at that wave of opportunity, are we ready? How do we stay coordinated? How do we assimilate the thousands of people? Like the majority of our company has joined during the pandemic. For a company that has really been built on vision and culture, it just creates a greater burden to communicate what our culture is and to share that vision. We've changed the way that we've had to do that. And I think we've done a lot better than most. But I'm so glad now to be making up for lost time, getting FaceTime with people. And there's still a lot of work that has to be done. The opportunity got bigger while we were trying to keep our head above water with all the changes in the world. So executing on an opportunity that just continues to get bigger is the biggest thing. I had a conversation with Bill Gates maybe a year ago, and I was commenting on how leading during the pandemic has been such a difficult thing, and his comfort was, well, it's a relative game. Like you're competing against other companies who are in the exact same environment. It's relative. Everybody's in the same, so they have to operate at the same disadvantage. And I believe because of that, we're doing just incredibly well. And we've gained land during that time, not lost it.
Shweta's been patient. So Shweta from Evercore, you ask your question, then we'll have one more question after Shweta.
Thanks, Chris. Shweta Kajuri at Evercore ISI. I have a question on OpenPass. So how does that work? And is the goal, what would make you all happy? Is the goal to get to a certain opt-in rate? Or as a consumer, if I go and say yes, and then I just have to, it's an SSO across everything, will we start seeing that? And what goal are you trying to get with that?
Sure. So, Jeff talked a bit about how low login rates are currently on journalistic outlets today, right? And so when they look at their revenue model, you can obviously charge higher CPMs when you know who the user is. And they have a huge amount of readership that is not currently logged in. And so the example there is, how can we help make sure that users are logged in, but that it's an easy process and that it's easy to log in across the internet as opposed to needing to create a separate username and password for each site. So I, as a user, go to the first publisher, I get the email to authenticate it, and then when I go to the next publisher, that's also an OpenPass participant, rather than needing to create a separate set of credentials or needing to log in a second time, it just pops up to say, this website also uses OpenPass, would you like to log in? And all I have to hit is yes. So it's a much easier consumer experience, and it creates a cohort of different publications that all participate so that I'm more apt to go and log into those different ecosystems using my OpenPass credentials. That then creates a much higher level of logged in users across these different sites as opposed to needing to create a separate account for each one. And so we've seen that kind of success demonstrated across the board. So the goal is to create a larger logged in user base across the open internet, which doesn't exist at the scale that we would like to see today, just based on consumer behavior. The other piece that I would add is today a lot of the publications that are using some sort of site, again, in addition to being a separate set of user credentials, frequently you're dependent on a third party to try to figure out what that email address is or what the customer provided information is. And so they're now saying, great, I'm at Apple's beck and call to figure out who this user is that's using their login or Google's login to access my site. And as we've seen, when you have that third party intermediary sitting in the middle, it's really easy for them to say, I'm not going to actually pass you back Samantha's email, even though she entered it with the attempt to communicate with your site. I'm going to pass you back user ID 123 or this fabricated email address. And you've now given up your direct relationship with the consumer. And so it's to the publisher's advantage as well to use this particular technology to drive increased adoption and to make sure they maintain control with their users.
I'm just going to summarize because she nailed it. And that's preserve the quid pro quo of the internet. If we do not have something like OpenPass or a single sign-on that powers the entire open internet, then either you have logins all over different websites, and so you're not going to create millions of logins. So that either means that the long tail suffers and the internet gets way smaller, or else somebody like Google gets even more power. Because every publisher will be even more at the mercy of Google because all authentication will be done by them. And there's already a sense by many of them that they've had to outsource their business and sort of hope they get paid adequately. And the concerns have been growing from advertisers for a long time. But it took longer, but the slope of that concern, if we're graphing it, is much steeper on the publisher side now too. So the fact that both of them are looking for opportunities, we think there's just a great opportunity, especially on the head of both advertisers. Again, that head and very long tail, the head and torso. You don't have to convince that many people if you get the publishers to adopt it, because then you're touching everybody. Like, find a consumer that doesn't touch the top 500, and I'm not sure they're really a consumer, right? So.
And then our last question will be from Justin Patterson at Key.
Great. Thank you very much, everyone. It's been a very informative day. Excuse me. Jeff, you led off the day earlier talking about how in January 2020, you wondered if you had the right level of investment in the business ahead of the wave that was forming. With the presentation today, obviously there's a very big wave forming. You characterized 2023 as being a potentially unprecedented year for TV transformation. So as you and Blake sit here today, how do you think about the right level of investment ahead of these opportunities, ahead of CTV, international, and SMB during a period of, as you said earlier, a lot of advertising volatility? I guess another way of characterizing it, how do you think about having the right guardrails for the financial profile, for the culture, so you don't wipe out what you've built? Thank you.
Thanks, Justin. And I like ending on this because I just think culture is just so important to our historical success, and it's just something that we obsess about. But then there's also productivity and responding to the opportunity. One of the things that I think Blake and I learned from the downturn that initially followed the pandemic in sort of summer of 2020 was that the concept, and this is the metaphor we used over and over again, I think we even did in our earnings report, when you're driving 100 miles an hour, if you slam the brakes and get to 30, accelerating and getting back to 100 is much harder than if you had just hit the brakes to go to 80. And making certain that you don't overcorrect, making certain that you don't slow down too much is something that I know will go into this uncertain environment constantly looking for. And we obviously have a much, quite literally, richer balance sheet this time around than we did before. So having the opportunity to respond to that and then acknowledging the fact that we did earlier that with economic pressure actually accelerates AVOD in the CTV world. So it's actually hard to imagine a world where we don't need to make investments. So the question is just like, how do we make those deliberately? And then you come back to the sort of end of your question, which is the real bottleneck or the real constraint is just making certain that we can assimilate and adapt our culture. And that's something that you really only learn by going to work every day, talking to the team, having great communication inside of our own four walls. And that's something that I think we've done well during the pandemic, but as we're getting back to the office, and we've asked everybody to come back on Tuesday, Wednesday, Thursday, with the exception of our engineers on Tuesdays, having people back has made it so that we just have our finger more on that pulse, and I think we're more equipped to make those decisions. But I'm sure I left something off, Blake.
Not really. I mean, all I would say is we do a lot of scenario planning. It's similar to like when we went into COVID, and nobody in this room knew what was going to happen. Our FP&A team, we ran 10 different scenarios of anything that could happen, talked about it, then talked about, okay, how can we prioritize resources? How should we stack rank those? What are the things that are the long, big bets that we want to make sure that we can make investments in? How do we keep those seated, but then also make sure that in the short term we're funding the things that are correct? I mean, I have a long-term mentality, but I'm also can make short-term tactical decisions as well. And I think to Jeff's point, it's really a bit more of taking the gas pedal and maybe pulling up a little bit rather than hitting the brakes. I've had the experience in my career where I've been in companies or divisions of companies where we hit the brakes, we hit it way too hard, and it took really long to get back on track with, it gums up recruiting, it gums up engineering and all these things. And generally you look back in hindsight and just wish you would have been more methodical about it. So that's why I tend to come at things from a lens of always thinking about productivity. It's not like in the heyday where it's go, go, go at all costs, because when the tide goes out, that's when you're exposed. And so that doesn't mean you're not going to have, short-term periods of volatility. It's going to happen. But I think by always having that perspective, it makes it a lot easier to adapt as things kind of evolve.
I just wanted to say thank you. I wanted to end by just, again, saying thank you. I'm so proud of what we've accomplished as a company since being public in just almost 6 years. What we've done in 6 years is beyond what I thought was possible for us to accomplish. I knew the opportunity was there, but could we actually execute it? And would we be this size? And would we be accomplishing all the things that we were, partnered with all these companies, really leading and empowering the open internet? It just wasn't something that we thought we would do in that moment. And to be in this place is only possible with you, each of our shareholders, and just so grateful for your support, for you taking the time to be here all day, but especially to put your money where your mouth is, and to be invested in something that I really do believe is making the internet better, making information better, and just having a positive impact on the global economy. So thank you.
Thank you, Samantha, Tim, Jeff, Blake. Thank you all. This officially concludes the Trade Desk 2022 Investor Day. We're going to open up the walls here, and we'll have a reception that you're all more than welcome to stay until I think it's about 6:15 when they'll start shutting us down. Thank you very much.